Welcome to Paycheck Paradox, the show focused on financial independence and proven strategies to reduce and ultimately eliminate your dependence on that W-2 income.
That's right. Our mission is really to equip you, the listener, with knowledge about these wealth generation opportunities that often get overlooked in all the mainstream financial noise.
Today, we're digging into the core strategy from our latest post on paycheckparadox.com, which is the picks and shovels investment strategy. It's all about finding that essential infrastructure that supports the biggest market trends.
Yeah, without having to bet on which company actually wins the race.
Exactly. We see all this massive hype around the direct winners, the Teslas, the Nvidias, the companies plastered across every headline.
But the most consistent wealth, it's almost always found in selling the tools, the infrastructure, or, the maintenance that the entire industry needs.
Okay, before we jump into the nuts and bolts, just a quick disclaimer. None of this is financial advice. We are just two people enthusiastically discussing some investment ideas for educational purposes.
Right. If you use this knowledge to launch a highly successful income stream that buys you a fleet of yachts, just please remember to invite us.
Absolutely. Okay, let's unpack this core analogy from the blog post. The California gold rush. Everyone remembers the image of the frantic prospector, but the reality is that the vast majority went completely bust. So why were the merchants selling picks, shovels, and denim jeans the ones who built these consistent fortunes?
What's fascinating here is the sheer consistency versus the extremely high risk. I mean, prospectors were betting on a binary outcome. Find gold or find nothing.
Right, win or lose.
Exactly. The merchants, though, they were betting on human activity. They knew that regardless of whether a prospector struck it rich or not, they would still need food, equipment, and clothing just to even try.
So they weren't betting on the outcome of the gold rush, they were. They were betting on the guaranteed, non-negotiable participation in it.
That's it. We call these the secondary winners. They operate in these high-volume, mandatory industries, and they often have much lower risk exposure because if one prospector fails, another one shows up the next day needing a new shovel.
That makes perfect sense for the 1800s. Let's look at today. Here's where it gets really interesting. Applying that mindset to modern crowded trades. Let's start with the big one, artificial intelligence.
AI, of course.
Everyone sees chip designers as the direct play. Nvidia. So what's the definitive picks and shovels perspective for AI, according to the post?
Well, the required infrastructure is it's staggering. AI models rely on these hyperscale data centers, which are consuming gargantuan amounts of power.
They're energy vampires.
Total energy vampires, and their usage is accelerating exponentially. So the shovels for AI are power and nuclear energy.
But why nuclear specifically? Why can't all the new growth in, solar and wind farms handle this demand?
That's a crucial question. The AI grid needs stability. Solar and wind are intermittent.
Right, the sun goes down.
Exactly. An AI data center needs stable 247 baseload power. You can't just let the servers go offline at night. Nuclear fits that bill perfectly as the only proven carbon-free source that provides that stable baseload supply.
So companies like Constellation Energy, Vistra, or NextEra, they're selling the mandatory fuel for the entire AI economy.
Precisely. But power isn't the only critical necessity. High-end AI chips run incredibly hot. So you also have the literal hardware necessity of thermal management, cooling.
And old-school air conditioning isn't going to cut it.
Not even close. Liquid cooling infrastructure is now mandatory to keep these densely packed chips from literally melting down. Companies like Vertiv and Modine provide this non-negotiable service. Their business just grows because AI usage and therefore heat generation grows.
It's a mandatory cost to doing business. Doesn't matter which language model wins.
Doesn't matter at all.
Okay, connecting this to the bigger picture, what about semiconductors themselves? If TSMC or Intel are the crowded trades, what's the crucial pick and shovel they use that gives the provider a true monopoly?
The bottleneck is the equipment needed to make those advanced chips, specifically lithography equipment. The post really focuses on ASML, which holds a virtual global monopoly on what's called extreme ultraviolet, or EUV, lithography.
Can you explain that a little? Why is this a true monopoly? Why can't Intel or Samsung just build their own machines?
It just comes down to the R&D cost and the complexity. Developing EUV tech is one of the most complex engineering feats in the world. It uses lasers to project patterns onto silicon at an atomic level. The investment is astronomical.
So the barrier to entry is It's impenetrable.
Completely. You physically cannot print a high-end chip today without these machines. That lack of competition gives ASML immense pricing power. They are the ultimate bottleneck play.
Fantastic insight. It really shows the power of owning the indispensable tool.
And don't forget the consumables. Chip fabrication requires ultra-pure materials, namely industrial gases like neon and helium. These are recurring sales needed for every single batch of chips.
Ah, so it's not a one-off machine purchase.
Exactly. Companies like Lind and Air Products thrive on that predictable, high-volume, recurring sales cycle.
Okay, and finally for tech, the massive cloud computing industry, AWS, Azure. Everyone talks about the software, but where does the cloud actually live?
It lives on the ground, in massive, secure, expensive buildings. The landlords of the internet are data center REITs. These firms, like Equinix or Digital Realty, they own the physical space and they collect rent from big tech.
Hold on, for listeners focused on stable income for financial independence, what's a benefit of owning a REIT? Maybe define that.
Good point. A real estate investment trust, or REIT, is legally required to pay out a huge percentage of its earnings, usually 90% as dividends.
So big tech's rent payments for server space flow directly back to the investor.
That's it. It's a highly predictable income stream, and it's decoupled from the volatile stock prices of the tenants themselves. They win as long as both AWS and Azure need server space to keep the internet running.
That stable income stream is exactly what our listeners are looking for. Okay, let's pivot. Let's look at how massive shifts in human biology are creating new sets of picks and shovels, starting with GLP-1 weight loss drugs.
Right. These drugs are creating enormous downstream economic shifts. Betting on Eli Lilly or Novo Nordisk, that's the direct play. But the real question is, what happens after the rapid weight loss?
And the Post points to the necessity of new purchases.
Yes. As people lose a lot of weight, they gain mobility, they adopt active lifestyles. This drives demand for gyms and activewear. They need new wardrobes, new sneakers, gym memberships.
So Planet Fitness, Lululemon, On Holding, their customer base is just getting healthier, more active.
Right, but you might say people only buy new clothes once. That's where the more surprising secondary winner comes in, aesthetics and skin tightening.
Ah, the Ozempic face issue.
Exactly. Rapid weight loss can lead to loose skin. This drives increased mandatory demand for fillers, tightening devices, and surgery. This is non-discretionary spending driven by the medical change itself.
That's a powerful example of looking 2 steps downstream. Companies providing those solutions, like InMode or AbbVie, which owns Botox, become the indirect beneficiaries.
It's necessary maintenance, creating recurring demand.
What about the electric vehicle revolution? If we avoid trying to pick the winner between Tesla, Ford, or Rivian, where does the pick and shovel money go?
You look at what every EV needs. First, materials. Copper miners. The difference is stark. An EV uses 3 to 4 times more copper than a gas car, mainly for the battery and wiring.
But mining is famously cyclical.
Yeah.
Why is this a safer bet than buying a car company?
Because you're betting on a massive guaranteed volume increase, not margins. It doesn't matter which brand wins or which country subsidizes production. The physical requirement for copper is non-negotiable, and it's huge.
So you're betting on the physical element required in every single car globally.
That's it. And second, consumables. Tire manufacturers. EVs are significantly heavier because of the battery pack, and they have instant torque, which puts immense stress on the tires.
And they wear out faster.
About 30% faster, yeah. It creates a high-volume, mandatory replacement cycle. Michelin and Goodyear are selling a non-negotiable part based on the physics of the vehicle, not its software.
Let's quickly hit a few boring but necessary sectors. E-commerce, Amazon, Shopify. You can't promise same-day delivery without physical space and packaging.
Exactly. That points directly to industrial real estate, specifically warehouses. These massive distribution centers near cities are the physical foundation for the digital shopping experience.
So Prologis and Rexford Industrial are the landlords collecting rent, insulated from Amazon's quarterly earnings drama.
Yep, and every single online order needs packaging and cardboard to survive shipping. Companies like Packaging Core and Westrock are selling low-tech necessities that underpin all high-tech online sales. The demand is just relentlessly upward.
And finally, a couple of big global trends, green energy and cybersecurity.
For green energy, the immediate roadblock is always transmission. Generating power is useless if the grid can't move it.
The grid is just too old.
It is. It can't handle distributed renewables. That makes grid infrastructure a crucial secondary winner. We're talking hundreds of billions in new cables, substations, smart controls, companies like Quanta Services or Eaton.
They're modernizing the pipes.
Right. And in cybersecurity, the reality is simple. Hacks are inevitable. That forces companies to buy cyber insurance to cover liability, fines, ransoms. The risk is rising, so premiums are skyrocketing.
And the insurers of the PNS play there. Chubb, Martian, McLennan.
They're benefiting from mandatory risk mitigation.
Okay, the Post also highlighted the construction boom. If home builders are the direct play, what do they need daily that they hate owning?
Heavy machinery. Construction firms prefer renting heavy machinery over buying it to keep their balance sheets light and avoid maintenance costs. This makes equipment rental companies, like United Rentals, the ultimate picks and shovels for the builders.
So let's bring this all together. What does this mean for the listener building a portfolio for financial independence? Why use this indirect approach?
The blog post outlines 3 major advantages, and they directly address that FI goal. First, lower volatility. If you invest in the copper for EVs, you win as long as the whole industry grows, regardless of whether a single EV startup goes bankrupt.
Right. Your success isn't tied to the CEO drama of one single company.
Exactly. Second, recurring revenue. A lot of direct plays are one-off sales, one car, one phone. Indirect winners often have high recurring revenue, selling the electricity every month, collecting the rent, selling the tires that need replacing. For FI planning, that predictability is gold.
It's the subscription model applied to critical infrastructure.
And finally, the valuations, better valuations. Because pick and shovel stocks are in boring sectors, utilities, mining, real estate, they tend to trade at much lower PE ratios, maybe 15 to 20x.
Compared to the hype tech stocks at 50x plus?
Easily. And that gives you a crucial margin of safety. When the tech sector corrects, stocks at 50x earnings can crash hard. But utilities selling power at 18x earnings, or REITs collecting non-negotiable rent, they have a much stronger fundamental floor.
It minimizes those portfolio drawdowns, which is critical when you're relying on that capital for passive income.
That is the definition of a margin of safety.
So the whole mindset is about looking at these huge, hyped industries and just asking, what does everybody need that they can't function without? That's the toll gate.
It's the difference between volatility and consistency.
A final provocative thought for you to chew on, building on everything we've discussed, which established fundamentally boring industry like specialized chemicals or heavy transport is essential to the success of the NEXT big consumer trend we haven't even identified yet.
That's where the true long-term value lies.
Remember, we publish a video on YouTube with visuals and charts covering this entire subject every week, so be sure to check that out as well for a visual breakdown of this strategy.
Thank you for listening to Paycheck Paradox.
And be on the lookout for the next episode where we dive into another angle of achieving financial independence.